mentioned the conference we're running today, and I think that's an interesting driver of what's going on in technology is just the sheer amount of investor interest in the sector right now. This is a conference we've been running for 8 years. It started with 10 companies and 40 investors. This year it's 40 companies and over 500 investors with over a quarter of the investors coming out of the U.S. So I think one key element of what's driving the shares is the sheer interest in technology. And one of the reasons for that is, as you mentioned, these new areas of tech, either where technology is going into older sectors and disrupting or actually enabling structural change in the sector, whether that be food delivery, whether that be telemedicine, whether that be digital fitness, and really enabling people to interact, to get goods, and to get healthy in a much more efficient way. And I think as the sector drives into some of these older areas of the way we live our lives, there's a lot of growth beyond just the traditional technology growth that was driving the shares. And so I think that's one of the real exciting elements of technology is the total addressable market is much, much larger than it was when it was just about software and semiconductors. And that's drawing a lot of interest of investors into the sector.
Matthew, I'm very interested in looking at some of the names you've got, whether it's digital fitness, telehealth or mobility as well. And to be fair, I don't really know many of those names. I don't think that's anything to be ashamed of. I think it's just the fact that they are below my radar on a daily basis. Why do they offer better value and more barriers to entry than some of the more illustrious names out there?
Well, I don't know if it's necessarily better barriers for entry, but I think the big thing with these companies is the growth potential. When you've got a 100 billion, 200 billion, 300 billion market cap, there's only so much further for the companies to grow. Most of the companies at our conference have valuations between 1 and 5 billion. The average growth rate of the companies at the conference is north of 75%. You look at that versus IT spending growth in the sector at about 5%. So in a market where the investors are looking for any type of growth, technology looks very good. These disruptive technology companies have growth you simply can't find anywhere else in the market because they're completely going into totally new markets or they're addressing an existing market in a totally new way where there's a huge market share shift available. So it's really about the growth opportunity relative to value makes these companies look to be extremely interesting investment opportunities.
Is it naive and disingenuous of me to ask if any of these companies have high trajectories of profitability rather than sales growth?
No, I mean that's one of the big differences from the dot-com boom of the early 2000s or pre the financial crisis is we actually have a much more healthy setup from the technology companies. Now, I'm not going to say that all the companies are profitable, but the big difference now is there is a focus on profitability at the unit level. So companies are getting funded only when they've got, or they're only getting sizable funding when they've proven the unit economics. They've proven that acquiring a customer brings in a customer that long-term is profitable. Now, near-term, the bottom line might not show black. It may still show red. But that's because they're acquiring new customers at a very fast growth, and those customers will pay out over 1, 2, or 3 years. So I think there's a very disciplined investment style that's going on and backing models that will work, even if today the bottom line isn't there because the market is favoring growth over immediate term bottom line profitability.